After studying this module, we shall be able to know the capital expenditure budget and research and development budget, understand cash budget and budgeted balance sheet, learn budgeted statement of changes in financial position, and explain the concept, purpose, and use of master budget.
A financial budget is a plan that embraces the impact of the financial decisions of the firm. It is a detailed pro forma schedule of financial activities and contains projections about incomes and expenses resulting from such activities, both on a long term and short term basis. The financial budget shows the effect of planned operations and capital investments on the assets, liabilities, and equity of the firm. The various types of financial budgets are: number 1, capital expenditure budget; 2, research and development budget; number 3, cash budget; number 4, budgeted balance sheet; number 5, budgeted statement of changes in financial position. Once all the financial and functional budgets have been prepared, they are incorporated in the master budget. A master budget is a comprehensive and coordinated budget which integrates the various component budgets and denotes the complete package summarizing and anticipated financial results of various business activities expected to be carried out by the organization during the budget period. This module deals with various financial budgets and the master budget.
The capital expenditure budget shows the estimated expenditure on acquisition of fixed assets such as plant, machinery, land, building, etc., necessitated on account of replacement of old machines, increased demand for products, expansion of industry, modernization of the plant, and adoption of new technology, etc. Capital budgeting is one of the most important areas of managerial decisions, such as decisions involve huge outlay, have long term implications for the organization, and are crucial for the achievement of organizational goals. Therefore, any error in this budgeting decision could prove to be fatal for the organization. The business firm should devise proper procedural methods for evaluating the merits of the project before committing funds. The alternative capital expenditure projects should be compared and evaluated in terms of expected sales, cost, revenues, and then the most profitable alternative should be selected. Capital expenditure budgets can be prepared for short range projects as well as long range projects. While short range projects are implemented during the current accounting period, long range projects cover several periods, so they are expressed only in general terms. When the time for their implementation approaches, then only then they become budget commitments. The capital expenditure budget should show the amount of original appropriations, the expenditure to date, new appropriations made, the amount of unutilized appropriations, and the balance amount carried forward to next year. Research and development refers to the investigative activities carried out by a business in order to experience future growth by developing new products or processes or improving existing products or procedures. The preparation of research and development budget facilitates the planning and controlling of R&D costs. The budget helps the business in planning the R&D programs it wishes to undertake, estimating correctly the staff and equipment requirements, making provisions for special facilities needed for the work, projecting the funds required for meeting the research costs, and assessing the fairness of these expenses. The research projects should be grouped into long term and short term projects. A short term research program is necessary for earning a satisfactory rate of return on the funds invested. A long term research program is essential to keep pace with the future market trends and demands. Research and development is generally discretionary, and therefore, when there is a decline in the income or financial position of the firm, some of the research programs may be deferred or aborted. A cash budget is an estimate showing the amount of cash which would be available in the budget period. The budget gives in detail the estimate of cash receipts and cash disbursements. The expected cash receipts depends on estimated cash sales, collection from debtors, sales of assets, borrowings, etc. The expected cash outlays depend on cash purchases, payment to creditors, payment of wages and salaries, repayment of loans, budgeted capital expenditure, etc.
The main objectives of preparing a cash budget are: number 1, to know the probable cash position as a result of planned operations so as to predict the shortages and surpluses of cash. This would help in making timely arrangements for short term borrowings to meet the deficit and invest the surplus cash in profitable avenues. Number 2, to maintain optimum level of working capital, keeping in view seasonal requirements, unusual receipts, unforeseen expenditure, possibilities of bad debts, etc. Number 3, to make arrangements for sufficient funds in case of some plant expansion programs. Number 4, to reveal potential cash shortages and explore the possibilities of procuring additional funds from sources such as bank loans, sales of securities, etc. Number 4, to use cash in the most profitable way by investing surplus funds in lucrative options. And lastly, to maintain adequate liquidity.
So, the cash budget is dependent on sales budget and operating expenses budget. These budgets themselves alone cannot determine an optimum cash position. This is because sales budget and operating expenses budgets are prepared on accrual basis, whereas cash budget is prepared on cash basis and does not include accrued items. The factors to be considered while preparing a cash budget are: 1. Estimated opening balance, 2. Estimated sales value in the sales budget, 3. Cash and credit sales ratio, terms of credit, period of credit, 4. Amount of monthly purchases as per the purchase budget, 5. Credit policy of the suppliers and credit terms, 6. Amount of salaries, wages, and operating expenses, 7. Capital expenditure plans, 8. And lastly, minimum cash balance to be maintained. The cash budget consists of two parts: 1. Cash receipts, 2. Cash disbursements. The cash budget figures are generally broken down quarterly wise, month wise, or week wise for adequate planning and control of cash requirements. The planning horizon of a cash budget depends on number of factors such as nature of business, size of business, cash position, the accuracy with which cash flows can be predicted, etc. Accordingly, the range of cash planning could be: number 1, operational cash planning, 2, Short range cash planning. 3. Long range cash planning. Operational cash planning. Cash budget could be prepared month-wise, week-wise, or day-wise, depending upon the informational requirements of management and for having dynamic control over the cash balance. Operational cash planning ensures that daily operational needs can be met out comfortably out of available cash resources. Short range cash planning. Here, cash budget is prepared for the full year and corresponds with the annual profit plan. It indicates cash inflows and outflows as generated by the annual profit plan. It helps in determining short term credit needs. Long range cash planning. Long range cash budgeting generally incorporates the effects of business expansion and long term trends. Its purpose is to find out whether cash can be generated through working capital growth and, in the event of a shortfall, how to make up the deficiency. A cash budget could be prepared using any of the three methods: 1. The receipts and disbursements method; 2. The adjusted net income method; 3. The balance sheet method. The receipts and disbursements method. In this method, the balance of cash at the end of a month, quarter, year is found out by adding to the opening cash balance of that month, quarter, year the estimated cash receipts from various sources and deducting cash payments to various agencies during that month, quarter, or year. The estimated receipts are attributed to cash sales, cash collected from debtors, dividends received, interest on investments, proceeds from sales of assets, royalties, bank loan, issue of share capital, and the like. Cash disbursements result from purchase of material, payment of wages and salaries, purchase of assets, repayment of loans, distribution of dividends, deposit of taxes, meeting of various expenses, etc. Therefore, the preparation of cash budget as per this method requires the use of sales budget, materials budget, labor budget, factory overhead budget, selling and distribution expenses budget, administrative expenses budget, capital expenditure budget, and research and development budget. This method is generally used for short term cash projections and is not appropriate for long term cash budgeting. Adjusted net income method. In this method, the budgeted profit stated in the income statement is converted from an accrual basis to cash basis. To achieve this, the budgeted profit of a period is adjusted for non-cash transactions and cash from operation is derived. For ascertaining this, non-cash items such as depreciation, loss on sale of fixed assets, bad and doubtful debts, and preliminary expenses written off, income tax accruals, etc., which were charged to profit and loss account, are added back as they do not affect cash position. Further, expected cash oriented changes in various assets and liabilities are analyzed to find their effect on cash resources. Issue of new shares, realization from sale of fixed assets, raising of long term loans, decrease in current assets such as debtors, stock, or bills receivables, increase in current liabilities such as creditors or bills payables, result in increasing the cash resources and are added. Similarly, redemption of preference shares, payment of long-term loans, purchase of fixed assets, payment of dividends, increase in current assets such as debtors, stock or bill receivables, decrease in current liabilities such as creditors or bills payable, result in decreasing the cash resources and are subtracted. Thus, budgeted cash at the end of the period is opening cash balance at the beginning of the period plus cash from operations plus net cash increase or minus net cash decrease as revealed by analysis of changes in various assets and liabilities. This method is useful in making long range cash projections. Balance sheet method. In this method, the closing balances of all the balance sheet items except cash and bank are determined and placed in the budgeted balance sheet. If the sum total of all the liability side items exceed the sum of the asset side items, the balancing figure denotes the cash or bank balance. On the other hand, if the sum of asset side items exceeds the sum of liability side items, the balancing figure denotes the bank overdraft or cash deficit. The amount of various closing balance sheet items is determined after their opening balances have been adjusted for the transactions expected to take place in their accounts during the year.
The budgeted or projected balance sheet portrays the expected financial position of the business on a particular date. It is prepared with the help of budgeted balance sheet at the start of budget period and the various operating and financial budgets prepared for that period. The balances in the opening balance sheet are adjusted in the light of anticipated transactions reflected in the operating budgets, capital expenditure budget and cash budget. If any of the accounts in the budgeted balance sheet or relationships in the accounts are not in accordance with the management requirements, then the operating plan is required to be modified. For instance, if debt equity ratio or cash ratio is too high or too low, the operating plan would have to be changed, or otherwise it would lower the credibility of the firm or adversely affect the value of its shares in the stock market. The projected balance sheet enables the checking of arithmetical accuracy of other budgets as they are all used in the preparation of forecasted balance sheet and any imbalance or incompatibility is revealed out.
Budgeted statement of changes in financial position is generally prepared from the budgeted balance sheet at the beginning of the budget period, budgeted balance sheet at the end of the budget period, and the budgeted income statement. This statement shows what changes have taken place in the various balance sheet items over a budget period and details about the possible causes of such changes. This projected statement of changes in financial position helps the management in financial planning.
Financial budgets are financial plans that are structured to detail projections or incomes and expenses on both a long term and short term basis. Budgets of this type normally incorporate aspects of other types of budgeting strategies, including the preparation of a detailed budgeted balance sheet, a section that functions as a cash flow budget and addresses the receipt of income and flow of expenses on an annual, semi-annual and a monthly basis. It typically covers a period of at least 1 year, although it is not unusual for some organizations to prepare this kind of budget to cover anywhere from 2 to 5 years at a time. There are a number of advantages associated with a well-crafted financial budget. One has to do with the process of setting short-term and long-term goals for the organization, assuming that the information used to create the budget is accurate. The document serves as a blueprint for operations from month to month while still making it possible to consider the long-term advantages of staying within that budget. From this perspective, it becomes a powerful tool for measuring how well the organization is doing with meeting its long-term financial goals and being able to periodically report those findings to shareholders or organization members in a timely manner. The most effective financial budget includes both a short-range month-to-month plan for at least a calendar year and a quarter-to-quarter long-range plan you use for financial statement reporting. It should be prepared during the 2 months preceding the fiscal year end to allow ample time for sufficient information gathering. The long-range plan should cover a period of at least 3 years, some go up to even 5 years, on a quarterly basis or even an annual basis. The long-term budget should be updated when the short-range plan is prepared. While some owners prefer to leave this 1-year budget unchanged for the year for which it provides projections, others adjust the budget during the year based on certain financial occurrences such as an unplanned equipment purchase or a larger than expected upward sales trend. Using the budget as an ongoing planning tool during a given year, certainly it is recommended. However, here is a word to the wise. Financial budgeting is vital, but it is important to avoid getting so caught up in the budget process that you forget to keep doing business.
Let us now proceed to the second aspect of this module, that is the master budget. A comprehensive budget or a master budget is a package comprising of various schedules and financial statements showing results expected in a future period. It consists of an income statement, a balance sheet, a statement of cash receipts, and disbursements and schedules of production, purchases, expenses, and fixed assets acquisition. The Institute of Management Accountants, London, defines a master budget as the summary budget incorporating its functional budgets which are finally approved, adopted, and employed. Thus, it is a summary budget which incorporates and integrates all other budgets. It is the end product of the budget making process. The master budget is presented to the budget committee for approval before it is operationalized. Many a times, number of master budgets have to be prepared before the final one is agreed up upon.
The master budget is the aggregation of all lower level budgets produced by a company's various functional areas and also includes budgeted financial statements, a cash forecast, and a financial plan. The master budget is typically presented in either a monthly or quarterly format and usually covers a company's entire fiscal year. An explanatory text may be included with the master budget which explains the company's strategic directions, how the master budget will assist in accomplishing specific goals, and the management actions needed to achieve the budget. There may also be a discussion of the headcount changes that are required to achieve the budget. A master budget is the central planning tool that a management team uses to direct the activities of a corporation as well as to judge the performances of its various responsibility centers. It is customary for the senior management team to review a number of items of the master budget and incorporate modifications unless it arrives at a budget that allocates funds to achieve desired results. Hopefully, a company uses participative budgeting to arrive at this final budget, but it may also be imposed on the organization by senior management with little input from the employees. A master budget is a set of interconnected budgets of sales, production costs, purchases, incomes, etc. And it also includes pro forma financial statements. A budget is a plan of future financial transactions. A master budget serves as planning and control tool to the management since they can plan the business activities during the period on the basis of master budget. At the end of each period, actual results can be compared with the master budget and necessary control actions can be taken. The components of master budget are interconnected, which means that numbers from one component budget flows to another one. For example, sales budget numbers are used in schedule of cash receipts from customers, and unless the sales budget is prepared, we are unable to prepare schedule of receipts from customers because of lack of information. This means that components of master budget must be prepared in specific order. We have ordered the above list in such a way that the necessary information needed by any component budget is provided by preceding component.
A master budget takes the macro view of business and covers the entire system, whereas operating budgets are concerned with one particular aspect of the business and provide plans for some specific set of activities such as sales, production, purchase, selling activities, etc. A master budget acts as a tool for coordinating all the individual budgets. It coordinates sales with production, production with purchase of materials and labor, and so on. This way, it cuts across the divisional boundaries in order to coordinate and synchronize the organization's diverse activities. This coordination and cohesiveness among different budgets enables management to make better predictions, take better decisions, and overcome challenges. It reveals whether top level management goals of revenue expenses, income, cash, and financial position can be smoothly achieved or not. It is supplemented with important accounting ratios such as current ratio, liquidity ratio, profit to capital employed ratio, etc.
Let us now recapitulate what we have learnt in this module. A financial budget is a plan that embraces the impact of financial decisions of the firm. It is a detailed pro forma schedule of financial activities and contains projections about incomes and expenses resulting from such activities both on long term and short term basis. The various types of financial budgets are 1. Capital expenditure budget, 2. Research and development budget, 3. Cash budget, 4. Budgeted balance sheet, 5. Budgeted statement of changes in financial position. The capital expenditure budget shows the estimated expenditure on acquisition of fixed assets such as plant, machinery, land, buildings, etc., necessitated on account of replacements of old machines, increased demand for products, expansion of industry, modernization of the plant and adoption of new technology, etc. Research and development refers to the investigative activities carried out by a business in order to experience future growth by developing a new product or process or improving existing products or procedures. The preparation of research and development budget facilitates the planning and controlling of research and development costs. A cash budget is an estimate showing the amount of cash which would be available in the budget period. The budget gives in detail the estimate of cash receipts and cash disbursements. The expected cash receipts depends on estimated cash sales, collections from debtors, sales of assets, borrowings, etc. The cash budget consists of two parts, namely cash receipts and cash disbursements. The cash budget figures are generally broken down quarterly wise, month wise or week wise for adequate planning and control of each requirement. The range of cash planning could be A. Operating cash planning. Cash budgets could be prepared month wise, week wise or day wise depending upon the informational requirements of management and for having dynamic control over cash balances. Operational cash planning ensures that daily operational needs can be met out comfortably out of available cash resources. B. Short range cash planning. Here, cash budget is prepared for full year and corresponds with the annual profit plan. It indicates cash inflows and outflows as generated by annual profit plan. It helps in determining short-term cash requirements. C. Long-range cash planning. Long-range cash budgeting generally incorporates the efforts of business, expansion and long-term trends. Its purpose is to find out whether cash can be generated through working capital growth and in the event of shortfall, how to make up the deficiency. A cash budget could be prepared using any of the three methods, namely the receipts and disbursements method, 2. Adjusted net income method, 3. Balance sheet method. The budgeted or projected balance sheet portrays the expected financial position of the business on a particular date. It is prepared with the help of budgeted balance sheet at the start of budget period and the various operating and financial budgets prepared for the period. Budgeted statements of changes. Financial position shows changes that have taken place in the various balance sheet items during the budget period. A master budget is a set of interconnected budgets of sales, production costs, purchases, incomes, etc. and it also includes pro forma financial statements. A budget is a plan of future financial transactions. A master budget serves as planning and control tool for the management since they can plan the business activities during the period on the basis of master budget. At the end of each period, actual results can be compared with the master budget and necessary control actions can be taken.